All right, let's recap what we witnessed Wednesday that might go down as one of the most aggressive short squeezes in market history. The bears would call it an orange swan event, a sudden irrational move sparked by a single unexpected post. The markets ripped, and it was actually one of the biggest one-day point gains in the last 5 years. Trump's post triggered a historic moment, a VIX collapse and a wave, a forced covering that slaughtered the bears and for at least one day killed the bearish narrative. But here's where it gets interesting. Then we got today's CPI, and it came in cooler than expected, and yet futures reversed hard in pre-markets, bringing the bearish cloud back. And as the day went on, buyers did begin to slowly, cautiously step back in, but it's left us with this question about whether or not we're in a bull or bear move right now. Obviously, we've been trending down, and we've only had a little bit of a reprieve from this sell-off, and so we've got to analyze this moment correctly. Ultimately, I've been saying it, we've seen it all in recent days, a failed dead cat bounce, a failed melt-up, and then we got the failed relief rally, and now we have to ask ourselves the question, will the short squeeze turn into that V-shaped bull run, or is it just going to be another failed bull push? Now, before I break this down any further, if you guys like the style of my market coverage, I'd like you to take a minute, hit that like and subscribe so you can get the next video. You can also follow me on the X platform, aka Twitter, at SWJGoat. Over there, I'm giving intraday charts, updates, and sometimes just some humor. Because some days on Wall Street, after you're done crying, you absolutely need to laugh at it all. And in addition to that, I have my pro trading community, the ChartGoat University. And as usual, I gave 3 A+ trade setups this morning, and all of them worked very, very beautifully. I know a lot of you guys made some money because I saw it posted in the Wins channel. If you guys don't know what I'm talking about, each and every day before the market opens, I let everybody know what are my trend lines, what am I trading? And very consistently, these have been winning. No false signals. A false signal is when it crosses the trend line but reverses and goes the opposite direction. If you hold that position in a leveraged option play, obviously you're going to lose. But my trade setups have been working that when the price has been crossed, these have been continuing in that direction with volatility. Initially today, Tesla was quite volatile, but as you can see, it continued to break each level down, going further all the way to my third target and beyond. Now, the specific play was for a drop under $261.50, and it went all the way down to $239. You know that there's hundreds of percentage points to win on that kind of a move. It was absolutely monstrous. Now, let me know and let everybody know in the comments section if you took the trade and how you did. Now, I did give some additional guidance on Tesla yesterday before the market even opened. We had some leaps and some skips, some long Tesla options, and I told everybody I was going to be locking in the profit because I was expecting this move down today. Basically, nothing has been fixed. I'm going to get into that here in this video. I'm not saying that we won't continue to move up or that we're automatically going down. I just knew that after a move like yesterday, the markets were going to digest this, and I wanted to lock in some of that premium gain. We did that on these expensive Tesla options, and you know that a good 60% on an expensive option is a ton of money. I hope you followed me in that as well. Now, we will be getting back into those same options, but we want to make sure that we're getting in at the right spot. Now, if you didn't trade Tesla well today at all, up or down, then it's time for you to come check out the Stocks with Josh Discord. I'm going to leave a link in the top pinned comment and in the description of the video, and the website is just the name of the channel. It's www.stockswithjosh.com. Come check it out. All right, let's get into it. The big news of the day is that the CPI came in cooler than expected. This is what everybody wanted, but it's not how the markets chose to react. The headline was at 3.5% and the core at 3.7%. That did initially trigger a very small pop, but futures quickly reversed hard in the pre-market, suggesting that the market had already priced all of that in and it wasn't really a big news event. The Dow went on to drop 2,100 points at its lows, and then the S&P gave back more than half of Wednesday's gains, while the NASDAQ fell 5%. Now, as I'm filming this, we're coming up off of our lows, but it was for sure a very volatile day. While all that was going on, gold hit a new high at $3,175 a troy ounce, signaling yet again a classic flight to safety. Wall Street and the hedge funds sold the rip again. Now, the big question is, do we have enough of a positive news event, or what is the next tweet that we need to get to take the next leg higher? Now, the sell-off that we saw today came after another White House clarification that the proposed tariffs on China that everybody thought was 125% were actually 145%. That move got everyone scared again and reminded everyone that not everything on Wall Street or Washington has actually been worked out. So while the inflation data gave bulls a small win, the overall market response says a lot more about fear than it does about hope, keeping us in a little bit of a bearish mind frame until we begin to break a high above Wednesday. That's how I view it. Now, this might surprise you, but of the 20 biggest single-day percentage gains in NASDAQ history, only 2 of them actually marked real bottoms. The rest, they all happened in the middle of a bear market or in a downtrend. I got to give a shout out to Ray Dell, who initially put me onto that data point. In 2008, the S&P was up 11% in a single day, and then it made new lows just weeks later. And then in 1933, during the Great Depression, the market jumped over 16%. But of course, we know that wasn't the end of that story. As I've been saying, we have been way more like the COVID 2020 drop, the 2008 Great Recession, and we still keep getting these similar references to the Great Depression. This does appear to me to still be an unprecedented, unresolved, historic moment on Wall Street. So the point is that big green days don't mean it's over, and they often happen when volatility is still high and short positioning is elevated. It was a short squeeze. So the next time that we see a 5% move on the NASDAQ, we're absolutely going to have to ask ourselves, is this the bottom or is this just the eye of the storm? Now, a lot of people are asking, what made Trump post that tariffs were paused when he actually did? This is really the underlining question. It wasn't just the stock market reaction or the noise of social media. The pressure, in my opinion, came from behind the scenes, from the countries that were getting hit the hardest by the tariffs. And here's what matters. After that announcement, the 10-year Treasury yield dropped because leading up to it, the 10-year had jumped from 3.89% to nearly 4.5%, and it did that in just 2 days. That is a very, very serious move. Now, the greater reality is that some of those foreign governments were dumping treasuries, pushing against this whole tariff war, driving the yields higher, and shooting a warning shot over Trump's head. So the end result was that someone had to become the fall guy and face needed to be saved, but this needed to be addressed. China was singled out and left to take the brunt of World War tariff. You know, in times like this, you know who your friends are on that global stage. And unfortunately, China right now is appearing to be more like an adversary than a global economic partner. Now, for context, every 1% move higher in interest rates adds about $300 billion a year to our debt payments, or $3 trillion over a decade. This is a huge problem. I've been underlining it in every video, and it doesn't stop there. Higher yields, they ultimately lock up the housing market, mortgage rates spike, and real estate slows to a crawl, which again is enough to impact the economy and bring down the GDP. Now, all of this brings us to the deeper issue, how the US is going to fund its way out of this mess. And you might have heard some people speculate that the Fed is going to monetize the debt. And I wanted to explain that because a lot of people were asking me questions about it. The simple answer is that the US runs a deficit. It spends more than it brings in. And to cover the shortfall, the Treasury issues bonds. Now, normally those bonds are meant to be bought by the public or institutions. But when they're not bought or dumped on during World War tariff, and then the Fed's got to step in and he's got to buy those bonds with newly printed dollars. This, of course, is what's driving inflation. And so it's a vicious cycle, and it's a very delicately played game. And we've got a lot of principled people in a very high stakes environment. Volatility, volatility, volatility is the result. He's essentially printing dollars to fund government spending, and that's what it means to say that he's monetizing our debt. This ultimately expands the Fed's balance sheet, increases liquidity, and in some cases holds interest rates down. But it also, as I said, comes at the cost of an inflation risk, currency debasement, and, as we know it best, the manipulation of stock prices. And as I've said before, the real problem is the interest payments. They're surging past trillions of dollars annually. This conversation is only going to get louder, and it comes down to one simple question: how long can we keep these interest rates this high and afford everything else? Now, this is where we get the Trump put. He's using policy posts to put a floor under volatility. And at this time and at the last moment, it did bring the markets some breathing room, at least for a moment. Now, this isn't just speculation. JP Morgan literally built an index to track Trump's impact on the market through tweets. It's called the BloFin Index. I'm not sure if you've heard about it. It's named after one of Trump's more cryptic tweets. The goal is to measure the impact of presidential posts, especially on Treasury market volatility. And here's an interesting fact, and it's actually very, very important. This week's post on tariffs triggered more market movement than any Fed speech yet. And that tells us something very interesting. Clearly, in a market environment where a single post can move yields more than any economic data. Now, if you're wondering, the BloFin Index isn't tradable. There's no public ticker or ETF. And I guess Vegas is going to have to pick that one up if you want to be a speculator on Trump's next post. It is the measuring of the orange swan impact. No disrespect meant. And as one analyst joked, it was done to acknowledge an underlying expectation of the next 5 years, which is becoming a true catchphrase on Wall Street: MVGA, make volatility great again. Perhaps you have heard it. I'm sure you have felt it. Now, I know this trend is going to continue, and that's why I've been suggesting to control your greed when going long or short, because at any given moment, the post can strike and the markets will move. So here's the big question. After the CPI print and the market's mixed response, are analysts shifting their call for a recession? At the moment, JP Morgan and Goldman Sachs are still maintaining a no recession base case, but they've walked back the number of expected rate cuts. The bond market doesn't seem convinced either. The soft landing narrative, in my opinion, is still alive, but barely. And another big question is, if the CPI can't drive a trend, what will? I'm going to continue to watch all of it: CPI, yields, and sentiment. And all the while, what I'm really wondering is, when is the AI trade coming back? That's where I really feel like the markets are going to thrive, when they can let go of the tariff war and inflation can somewhat be under control. I believe that AI will come raging back. In my personal opinion, the United States is on the edge of one of the largest economic booms, one of the biggest impacts on productivity that has ever been achieved through innovation, through AI, and through Tesla robots. It's one of the reasons why I continuously have been nibbling on NVIDIA, Palantir. We recently talked the other day about SoundHound. It turned out to be any buy then, turned out to be a good buy for now, but I'm definitely leaving some dry powder to be able to continue to buy the dip, because I'm not at all convinced that anything has been solved. It's only being maintained, and the market's only experiencing massive volatility swings. Until then, we're going to continue to trade the trend. I appreciate you guys watching. I appreciate the likes. I appreciate the comments. Again, hit that subscribe to get the next video. And don't sleep on the Stocks with Josh Discord, because I'm going to be live trading with the family tomorrow, hoping for some nice big fat gains. We're going to do it. It's going to be a coaching session. It's going to be a teaching session, and it's going to be a trading session. I appreciate all of you guys joining me today and making it to the end of the video. Peace and blessings. We'll see you tomorrow.